Hi dear traders, last week was quite optimistic for investors. The stock market was actively rising to its highs amid strong macroeconomic figures, which raised hope that the US economy is able to cope with the negative consequences of the high interest rates. Tomorrow the US is going to disclose its inflation data. If the growth pace slackens, the market situation will become even more positive for investors. Let us find out what happened last week. At the end of the previous week, the US dollar index added 0.79%, setting at the level of 104 points. Traders welcomed the US Labor Department report, which showed that the number of new jobs in the non-farm sector increased more than anticipated. Since the labor market situation remains stable, the Fed may refrain from lowering the rate, which will support demand for the US dollar. Meanwhile, the euro is suffering losses. All the macroeconomic reports are pointing to negative trends, which are causing a decline in the single currency. In other words, traders are more actively buying their greenback. Dovish statements provided by the ECB officials also exerted pressure on the euro. Isabel Schnabel, a member of the executive board of the European Central Bank, made it clear that the central bank had finished its hiking cycle after inflation figures for November unveiled a slowdown to two-year lows. At the same time, François Valeroy de Gala, a member of the European Central Bank's Governing Council, noted that inflation was falling faster than expected, thus increasing the likelihood of a key rate cut in 2024. Under such conditions, traders are likely to sell the euro. Traders are also showing the same attitude towards the British pound. The pound-dollar pair dropped to 1.2500, although it jumped shortly after it failed to recoup all the losses. Thus, the pair closed the previous trading week at the level of 1.2550. Investors are trying to predict the future actions of the Bank of England. The central bank will hold a meeting on Thursday. It's expected to keep the benchmark rate unchanged. Notably, the key rate cut may take place only in June. The yen was the main beneficiary of the previous week. The dollar-yen pair dropped to the level of 143 yen. This is how investors are reacting to the signs that inflation has resumed rising. This may force the Bank of Japan to end its ultra-loose monetary policy and raise the key rate to at least zero. Even Bank of Japan Governor Kazuo Ueda supported the necessity of ending the negative rate policy earlier than planned. It's an extremely hawkish decision for Japanese officials. Against this backdrop, demand for the yen surged. Gold also showed high volatility. Speculations about the possibility that the Fed will keep the key interest rate at high levels for a longer period forced investors to switch to bonds. The capital outflow led to a decline in gold to $2,025 per troy ounce. After the publication of the US employment data, the number of sell orders increased, thus pushing gold to $2,000. A sell-off was also recorded in the oil market. There are both technical and fundamental reasons for that. First of all, exports of US crude to Europe and Asia soared to all-time high of 6 million barrels a day. Meanwhile, macroeconomic reports from all over the world are reflecting sluggish demand for energy. It means that the oil market could become oversupplied despite the OPEC Plus decision to reduce oil supply even more. In this light, BRENT crude slid to $75 per barrel. These are the trends of the last trading week. Do not miss our daily news reports to be always in touch with the latest events. See you!